Hello everybody, welcome to today's session. We've got a nice full room. It's gonna get pretty technical today. Actually not pretty technical, it's gonna get very technical today. I hope everyone's ready for looking at some source code. The title of today's presentation is obviously Developing Pair Trading Strategies with Seer. I hope you enjoy it. So look, it's going. I've actually got Jeremy on the line as well, who's going to help me handle any questions that any of you may have. So if you have questions, I'm kind of going to be concentrating on my presentation, and Jeremy will try and answer as many questions as possible, and he'll keep track of any interesting questions and let me know about them later on in the presentation, so I can go over some of the answers. So obviously there will be a recording of this presentation. You may need to look at it because it is going to be very, very technical and code based. And of course, if you have any questions, just drop us an email, support@seertrading.com, or just ask us now in the chat window. So let's just get going. So first things first, I've set up a little trading system. In fact, I just wrote it last night. It's super simple pairs trading system. I've already written it and backtested it. The reason why I backtested it was because I wanted to backtest it on quite a significant amount of data to show you all what happens. And so backtesting takes about 10 or 15 minutes. So I've already backtested it, so I'm not going to re-backtest it during this presentation, so the results are ready to go. So very simple. I've just created the system. I called it Pairs Movement Arbitrage. I put $50,000 of Monopoly money in my account. I've got no begin and end. My system is set to a one hourly heartbeat. That means the backtesting runs on hourly heartbeats. So now the next thing that I need to do is I'm going to do a few things. Firstly, I want to allow multiple orders for each instrument, right, for each symbol. This is important because what I'm going to be doing is I'm going to be actually trading every pair against every other pair, right? So I've got 7 currency pairs that I've exposed to this to the system, and I'm going to be trading each one against each other one. So I need to be able to enter multiple orders for every symbol. The second thing that I'm doing is I'm going to tick this section called Implicit One Cancels All, OCA groups for symbols. What that means is that this tells Seer when I enter the market and I create a stop loss or a take profit position, and any one of those gets triggered, it actually cancels all the other pending orders that are associated with that order that was triggered. So that's important for us as well in this pairs trading strategy. So I will, and of course what I'll do is I will actually get back to these topics a little bit later on when we're actually looking at the code. I've added 7 major currency pairs, so Euro, New Zealand, Cable, Australian, Canadian, Swissy, and Japanese yen, all against the US dollar. I've added them to my portfolio. Those are the ones I'm going to be trading. And again, I want to highlight, very important for pairs trading is to basically add in the list of instruments you want exposed during your system, because by default Seer just exposes the current instrument you're on, right? So if you're, let's say, on the begin event and you program stuff into the begin event, that would just have access to the current symbol that Seer is looking at. But if you define your instruments in this little block over here, it exposes all the other instruments as well. All right, so I've defined a few variables. So I'm clicking around there unnecessarily. I've defined a few variables in my system. I use a P, that's a period of 24, min observations of 504, that's about a month, and position size of 5,000. So I'll describe what each of these variables and how I use them later. And what I'm really doing in the system that it was a very, very simple backtesting pairs trading strategy. Essentially what I'm doing is this. I'm looking at the difference between every instrument and every other instrument in terms of its log movement. Okay, if any of you know anything about statistics, a log movement basically just creates a log normal distribution of movements. And I get the standard deviation and the mean of that movement, and if it goes outside the mean and the standard deviation, I basically take a position in opposite directions. So essentially what I'm trying to say, to put it simply, if while two pairs of instruments are trading or moving similarly to each other, I don't do anything, but as soon as they move outside of their normal movement in relation to each other, I basically take opposite positions on those instruments. So what I'm going to do in this presentation is actually walk through every line of code and explain how it all works. The first thing I do for reference purposes, I create a variable called S0, which just contains the current symbol that I'm working on. Of course, Seer is context driven, so it would execute this bar method for every instrument in my portfolio. So it would execute it for Euro USD, it would execute it for USD JPY, etc., etc. Right? Then what I do is I create basically a list of movements for the current instrument. I call it S0 MOV. It is essentially just the movement of the current instrument for the last P intervals, right? So my P was set to 24. I don't know if you recall in my variable section, my P is 24. So basically, essentially what this line means, it creates an array called S0 MOV of the current close minus 24 hours close ago. All right? So it basically gets the difference in the movement over the period of 24 hours. I have a variable called trade. You'll see how I use it later. Basically, that tells me which direction I want to set my position for that instrument. Now, this function that I'm going to now on line 6 is actually the key to in all the pairs trading strategies in Seer, and this is called portfolio symbols. Now, portfolio symbols returns back an array of instruments that are in your portfolio. So if I call the function portfolio symbols, I would essentially get back this list: Euro USD, NZD, USD, GBP, AUD, CAD, Swiss franc, Japanese yen. But of course, I don't want to trade Euro against itself. So essentially, I call this function called portfolio symbols X. X says, return me back everything except for my current instrument that I'm on. So if I'm currently trading, let's say in the context of Euro USD, it will return back all the other 6 pairs. Next, what I do is I iterate over every instrument returned in my symbols array, and I call that instrument S1. Now, the same what I did for S0, I create a list of movements over a period of 24. I do the same for S1 to get a list of movements over a period of 24. But notice something very important. In my current context of, let's say I'm trading Euro USD, I could use just the function called close, right? That will give me the closing values of Euro USD. But if I want to use another instrument's close, I would have to prefix it with, you know, the variable that defines that instrument dash close, right? So this is very important to use this. If I just used close, it would obviously just reference the current symbol in the current context. So essentially this line 9 and line 2 are identical, except for the fact that I've got all the functions and the closing values preceded by the word by the variable S1. The next thing that I do is I get the differences between the S0 movement and the S1 movement. I then get the standard deviation of those differences. So the differences are defined in the variable called diff. I get the standard deviation of those movements, and I get the moving average of those movements. Now you may ask, why don't I just get one standard deviation value? Now the way Seer works is that it's column-based. Column-based means that functions like standard deviation and SMA, simple moving average, actually return back arrays and columns, right? So it doesn't, so calling something like stad_dev, standard deviation, on the array difference doesn't return back one value. It actually returns back the entire list of almost the moving standard deviation, if you know what I'm trying to say. Right? And the parameter there I put was minimum observations, which you remember from my variable section was set to about 504. So I'm looking at about 504 hourly candles, which is approximately a month. So I've got these two arrays. One is called SD, which is the standard deviations, and one is called mean. And now what I do is I actually get my latest values for those means and standard deviations. Now Seer has this function called now. Now basically gets the latest value of an array. So it gets the latest value of diff, the latest value of SD, and the latest value of mean. Okay, so essentially what we've done is we've taken two instruments thus far. We've worked out their movements over a period of 24 hours. We have kind of this rolling window of 24 hours. We create a difference between those two instruments. We've got the standard deviation and the mean for those differences. Now what we're going to do is we're actually going to decide whether we're going to take a position or not based on the current movement. So very easily, I just check, is my current movement, which is my latest move, greater than the mean plus 2 standard deviations? All right? Or is my latest movement less than a mean minus 2 standard deviations? So essentially what we're saying is the latest movement is too little or too big. It's out of the norm. In fact, 2 standard deviations is close to like 80 or 90%. I don't remember my stats off the top of my head. So it's got a 10% or so, 15% likelihood of this event actually firing. So now, once I'm in this section over here, after line 20, if that criteria is met, I'm essentially saying that I need to take a position. Now, I don't know which position I need to take in which direction, right? So I have a small heuristic. Essentially, in line 22 through 26, I just decide, based on the latest movements of the current instrument, whether to trade it short or long. So I basically say the latest close minus 24 hours ago. If the movement was positive, then I'm going to trade this instrument positive, and I'm going to trade the opposite instrument negative. So I set dollar trade to 1, which means I'm going to trade in a positive direction long on my current context instrument, which is, let's say, for example, Euro USD. Okay, so now I'm going to bring you to another highlight, focus on another very, very important thing to do with pairs trading. The first one was portfolio symbols, which allows you to iterate through instruments in your portfolio. The second very important thing is a function called Forex units available. Now, not many, in fact, no platforms that I know of allow you to do this type of functionality. Now, if in pairs trading, obviously they have different pairs. Let's say you're trading pairs like Euro USD against USD Japanese yen. They have differing dollar values, right? Those currencies. So you cannot trade 1,000 units long of one instrument and 1,000 units short of another instrument. Why? Because the 1,000 units could actually mean different exposures from a dollar perspective. It's very important to take equal exposures from a dollar value for your portfolio. So if you're trading Euro USD versus USD Japanese yen, you need to make sure that, let's say, you take $1,000 worth of exposure rather than 1,000 units. Okay, so what I've done is, if you recall, I've got this little variable defined under my variable section called pos size. Pos size is basically, for me, what I've defined as what I want my dollar position size to be. So when I actually call Forex units available with pos size, it essentially tells me what is the equivalent amount of dollars what is the equivalent amount of units for the instrument I'm currently trading that relates to $5,000, right? So let's say for Euro USD that could mean 5,000, but for USD Japanese yen it could mean 8,000 units. This is very, very important. Many people forget this in pairs trading, and they take disproportionate positions on their instruments, and then they wonder why their systems are lopsided. Obviously because their exposures are completely different. The next thing I do is something which is necessary for the FXCM platform because FXCM takes trades of 1,000 unit sizes. So essentially a round to unit size just converts whatever Forex units available returns into units of 1,000. Now what I'm going to do in my trading system that I've defined is essentially I am taking a position when the movement of two instruments is not aligned with historical movements, and I'm going to set market orders or pending orders at certain exit levels. So to calculate my exit level, what I'm going to do is I'm basically going to take the high minus the low over the last 504 observations. So basically the average of the high minus low of so literally the average height of a candle for that instrument. That's what I'm going to set as my stop loss and take profit. And the same thing I'm doing for my contra symbol. What I call my contra symbol is the symbol against which I'm actually trading as well. So what you can see there is I'm taking S1's high minus S1's low. I'm taking the simple moving average of that, and then I'm just taking now the latest value. So essentially my take profit and stop losses are one average high minus low movement from where I open my position. So based on what my trade variable is, I look at my what direction I want to trade in. So essentially if trade is greater than 0, it means I want to buy the current instrument I'm trading, my current context. I want to sell the contra symbol, right? So first thing I do is I create what I call an OCA group. Now one cancels all group. This means that if I trade and I create a trade with this OCA value, it's almost like you can call it like a unique label for a position. When I take a position for a stop loss and a take profit for my pending orders, I give it the same OCA group. And when that position, one of those gets hit, either take profit or stop loss, all the other pending orders will be closed automatically in the market. They won't be executed. They'll literally be cancelled. So what I'm doing is I'm saying buy market for the current instruments, let's say Euro USD. I pass through this OCA group name that I've got. I pass it the amount of units, right, which we calculated up here on line 30. And then what I give Seer is some information for the on full event. Now again, remember, Seer is event-based, right? So what's going to happen is that once my market order gets filled, Seer is going to call an event called order fill. Now, what I want to send through to this order fill is the direction of the trade, my OCA name, my take profit level, my stop loss level, and the amount of units. Now, all that information is going to get passed through to my on fill event, which we'll go to now, so that I can actually set appropriate stop loss and take profit levels in the market. So I place an order on my current instrument, and I do the same thing for my contra instrument, and I give it a different OCA group, contra, with some other details in it. And I place a sell market. See, I place a buy over here and a sell over here. Or vice versa, if my trade value is negative, I'd place a sell market for my current instrument and a buy market for my contra instrument. Now, what we've got now is an entry into the market. Now, when these entries get placed, or when the orders get filled, Seer would call my order fill event. What I do in my order fill event, I get that those parameters that I sent through into a variable called R, and again I just go back into there and quickly show you where those parameters are. They're in an on fill event over there. Okay, those are the parameters, and I've got DIR, OCA, take profit, stop loss, etc. And now what I'm doing is I'm going to set a stop loss for a long position, right? Because the direction was long, and I place an order for a stop price, a quantity, an order type is an order sell stop, a label, and an OCA group. So essentially, I've got an entry in the market, and I've got an order with a stop price, a sell stop, and I've got a sell limit. These are for long positions. And then for short positions, I've obviously got a buy stop as my stop price and a buy limit for my take profit level. And so I have these two levels, and of course, because the OCA groups match, as one of these stop losses or take profits get hit, the system will automatically cancel the other positions. So I have back tested this system, this very, very simple system over this portfolio. Now, again, I just want to remind everyone that I'm trading. I'm not filtering anything. I'm not optimizing anything. I'm literally trading every combination and permutation of these instruments. So I haven't gone and just said I only want to trade Euro USD against GBP USD or only Euro USD against USD CAD. I'm literally trading everything against everything else. So, of course, there's a lot of work to be done on the system. In terms of actually doing the research for every combination of pairs to see which actually work out the best. And I'll give you an example. So as you can see over here, this is my results of my back testing. This was back tested, I think, over about a year and 3 months worth of data. We had, a net profit of $27,000 off a $50,000 position. The gross profit, the gross loss, my profit factor 1.71, my average win to loss ratios, my annual return of 39.9, my drawdown, whereas my peak to trough was about 28%. So it's not bad. I guess we can reduce our exposure on every trade to get better results. You can see that out of our trades, 56% were profitable, and a whole bunch of statistics. And the interesting thing is that the instruments that were contributors, the biggest contributors to our profit were actually Japanese yen, euro, and pound. The Swiss franc, the Australian dollar, Canadian dollar, and New Zealand dollar were not very good contributors. And I guess if one goes through some type of analysis, a more detailed analysis than I did for this presentation, one will be able to filter out a lot of these pairs that don't really work together in a pairs trading environment. But of course, I always try to highlight the fact that one doesn't really want to over-optimize too much, because then you're fitting. And then what if market conditions change, and what if the Swiss franc starts to act more like, the euro, right? Or become highly correlated, then you've eliminated exposure to potentially very profitable instrument. So one needs to really be careful about over-optimizing. Okay, so again, I'll go to my trading history. This is my trading history over that year and a half. This is obviously typical of pairs trading type graphs. You can see those jagged edges because, of course, for every profitable trade, we also have a loss-making trade, right? So you would very much find this type of jagged kind of zigzag results in pairs trading environments. Also, I think you can see very quickly there's a lot of work to be done here. Certainly over the last 700 trades or so, the system's been pretty flat, a little bit of an up, but pretty flat, which means the system hasn't worked so well. Obviously, the beginning of the year we did really, really well. So, of course, quite a bit of work still to do on that system, but certainly a very, very good start as a strategy. And I would guess that if Jeremy doesn't have a problem with this, I guess we could post along with this video the actual source code for this strategy. It's really simple and probably gives you a very good basis to do pairs trading in Seer. In fact, what we'll do is, I just realized this, we'll actually post it on the forum. I'll start a thread today or tomorrow, and I'll post I'll send a post through with the source code for the system. Of course, Seer also gives you, over and above this trade equity curve, you've got many other type of stats, or net profit by month, a return percent by month, and you can see the beginning of the year was really good for us, and then kind of the 2013 has been quite disappointing for us. Of course, they haven't put in any money management in this in this system, so my profitability was not my exposure on the market was not relative to my trade equity curve or my equity. I've always just taken $5,000 worth of exposure on the market. Of course, one needs to take that into account. And Seer, although this is not the topic of conversation, but Seer obviously has all the money management strategies built in. You just got to fill in all these appropriate bits here under the money management object. So you can obviously vary your position sizes. For the purposes of this presentation, obviously, I didn't do that. The last thing I want to show you, obviously, is that Seer gives you not only the trade equity curve, but it's very, very important to see the mark-to-market equity curve. And let me show you why. If you look at the trade equity curve, I'll just switch back to that quickly. If you look at the trade equity curve, it doesn't look like there's much of a drawdown, right? But actually, when we look at our results, we can see that the peak to trough drawdown was actually minus 28%. And you ask yourself, that doesn't look right, because the trade history, look at the trade equity curve. There's no minus 28% over here, right? And that's right. But if you are using a trading platform that's only showing you a drawdown based on trade equity curve, it's pretty meaningless information. You need to look at mark-to-market equity curve for your drawdowns. And this is the mark-to-market equity curve that I'm showing you now. A mark-to-market equity curve is the equity curve for every bar that you analyze in your system, right, including your open equity. That means that this curve here, your mark-to-market equity curve, is your available equity or cash position, actually total equity, for every single candle, not only when you open and close your positions. Because when you open and close your positions, that's, you're not seeing anything that happens in between while your positions are actually open. And this is one of the major problems in the retail FX space, certainly why so many systems seem to do well, on these copy follow platforms, where you go there and the equity curves look amazing. They really are amazing, the trade equity curves, except when you actually start following them, you actually get a margin called. Because why? Because the people haven't been fully transparent with you by not disclosing the mark-to-market equity curve. And now, as we go further in this mark-to-market equity curve, we see here a lot of volatility happening, right? And this is where we start seeing the 28% coming in, right? We can see this big drop over here, right, in the equity curve. That is actually where the 28% comes in. And again, it goes up again, right? But you see that this type of drawdown is not reflected at all in your trade equity curve. And this is why mark-to-market equity curve is obviously very, very important. Don't delude yourself. Don't think because your trade equity curve is good, this is why your system is going to do great in the market. You'll find yourself, tail between the legs, running back home, trying to figure out why you've been margin called on your automated system. Essentially, that was, I guess, about a half an hour presentation. I quickly want to run through what we did from a pairs trading strategy. Very important, this portfolio symbols X function, which returns back the list of instruments which are not in your current context. Very important is your Forex units available, which is gives you exposure which is equal in both directions of your positions, right? No matter what currency you're actually trading, that is very, very important. And of course, the OCA groups. The OCA groups are important because it allows you to make sure that your stop losses and take profits are cancelled. Okay, so I've got that's the end of my presentation. I've got some questions coming through, like, do we take into account a cost like spread or commission? Of course, we take that into account. You can actually set that up yourself. Within your data store, you can go into your data store symbols and see what instruments are available in your data store. Okay, and what you can actually do is the spread obviously comes from the provider, but what you can do is you can enter some slippage values. The slippage values would give you additional an additional slippage or cost into the system. So currently I've got my slippage as 1 for Euro USD, 1.5 for for 1 for USD JPY, 1.5 for Euro USD. You can of course add additional slippage values in there, to add in other types of slippage to test the robustness of your system. So of course, please go ahead and do that. And I will post the system on the forum, so you can just grab the code and run it, for yourself. I'm not going to test it right now. This takes about 10 or 15 minutes to run, but I'd be more than happy to post it onto my blog post with some additional slippage. But I hope that answers your question. I guess what I want to do now is turn to Jeremy or Ennis, who are on the line supporting me in this presentation, to find out if there's anything else that any other interesting questions that have come up. Jeremy or Ennis, are there any interesting questions that I can deal with? I know it was a very, very technical presentation, and I'm hoping the audience was able to follow everything that I was saying.
Hi there, Ellen. No, we've actually got a lot of people saying thank you and really enjoyed the presentations. No other questions coming up, but I think it's a great idea, as you say, to actually kind of put the video as well as the kind of the code as well.
Okay, great. So what I'm going to do is I'm going to put the video with the webinar videos, and then I'll put the code in a blog post later today or tomorrow. Yeah.
We can link to it from the video as well. So
exactly.
A wonderful presentation, Ellen. Wonderful, yeah. Really interesting.
Okay, good. So thank you, everybody. I hope you enjoyed that. If there's any questions, support@seertrading.com. Go onto the blog or the forums, and be in touch with us. We have a one-on-one relationship with all our customers. Be in touch with us, and we look forward to hearing from you.